Hi, welcome to Outlier Live. So let's try to answer a question: what Fed really wants. So if we talk about what Fed's job is, really they want to make sure the prices are stable. So the price stability is one of the key thing that they try to achieve, right? So there are few ways they achieve that. Historically, interest rate is their weapon of choice. They have increased interest rate in past to control the prices, and in most recent years, in last couple of years, they have started ramping up the interest rates to make sure that they control the inflation, they control those prices. So let's look at the impact of what happens at when they increase the prices, when they increase the interest rate. So that sucks the liquidity from the market, right? So now there are few things that they want to make sure that doesn't go haywire. For example, unemployment rate, right? So right now unemployment rate is hovering close to 3.8% right now. And if they really want for economy to do a soft landing, they want to make sure that it doesn't go haywire, it doesn't go to like 5%, 6%, more than that. They want to keep a check on the unemployment numbers, probably closer to 4.1%, that they want to keep the unemployment below that, right? And then they also want that CPI to go down, right? So that is another factor they consider. Right now, the GDP growth is around 2.1%, and they are forecasting that by sometime next year, the growth will be somewhere around 1.5%. That is still in their acceptable levels. So again, by doing all of that, Fed is trying to achieve their target inflation, and they want to control the prices, they want to bring the price stability in the market. Now there are certain factors which are out of control. One is rising energy costs, your oil prices, which may lead to inflation, which may actually adds to inflation. So they can't control energy prices. You have seen recent auto strike, like auto workers strike. So that is another factor that is not in their control, right? So you have to understand, on one hand, Fed is trying to uh, control the prices to make sure that there is a price stability in the market. On the other hand, there are these external factors that they cannot control, that impact their effort to bring those prices in control. So again, energy cost, your UAW strike, and then you talk about long term borrowing cost. I mean, that's not again in their control. When you suck the liquidity in the market, you are indirectly impacting that, right? And then there is another risk, is potential government shutdown. Every year you have seen that exercise where, you know unless you print more money, there is a risk of government shutting down. So there are many risks that are there. So again, uh, Jerome Powell is trying to make sure that they are considering all of these risks. And let's look into some of his comments from yesterday's meeting, and let's try to decode it. Okay, so first and foremost, that the comment that he made is like, he is saying that soft landing is a possibility. In fact, they want the economy to do a soft landing. Otherwise, it may not look good, because already there the unemployment is growing, right? So as I mentioned before, unemployment is closer to 3.8% right now, and their goal is for unemployment to not go above 4.1%. So that's a goal. The expected economic growth will slow down next year. That's what they're saying. From 2.1% this year to 1.5% next year. So expect, if there is an expectation that suddenly there's a, you know growth in stocks, growth in economic activity. Right now, let's keep our expectations low, because the market is going to stay like this. You may see a few weeks stocks going up, then something happens, there is a pullback. So expect the stock market to behave like what it is behaving right now for at least this year and sometime next year. And again, like, going back to some of these external factors, he did mention about, when they make these decisions, they try to consider these external factors, to decide whether they're gonna do another rate increase or not. So, based on the current projections, we may see another rate hike this year. But personally, this is just my gut feeling. Personally, I don't think it is going to happen, because right now the economy has started to see the impact of this rate increase that they have done recently. Remember that when rate goes up, the impact is not visible right away. It takes some time for the impact to be really, there to, like, companies will start seeing the pinch, right? So a lot of these zombie companies, which were seeing a lot of growth, you may start seeing some of those companies, shutting down, and the unemployment may go also up, and people may look at the current economic conditions, and they may want to, defer their, like, purchases of their homes, which is already happening, right? Interest rates are very high. Lot of people who are in their current mortgages at lower interest rates, they are literally thinking, because if they are selling their house, they have to buy another house, right? And then they will probably pay double than what they are paying right now. So what they are doing is they are not selling. And a lot of people who are on the fence to buy new houses, they are, making sure that they are extending their decision. So it has already started, the impact of this rate increase. We are already seeing it. And Fed has decided that they are not going to increase rates in this last meeting that happened yesterday. So again, I consider that they are still hawkish. Why? Because they are not telling that when they are going to start cutting down the rates. Because more they keep the rates at the current level, you will start seeing more impact in the economy. The slowdown will happen. The slowdown will happen. Lot of experts are saying that we may start seeing the rate cut from 2024. So expect somewhere around like 50 basis point rate cut in 2024. So, and again, they will start tapering down slowly, hopefully, from 2024. So we will see when that happens. But for now, I think there may not be another rate increase this year. They have already done enough. But the impact on the economy will be there. So you may see a lot of volatility in the market. So that is probably going to happen. All right, let's move to our next story. So I was reading about FedEx uh, profit beat yesterday, and their shares popped up around 5.7%, to $264. So, so FedEx really benefited from Yellow, which was another trucking company there from their bankruptcy actually. So a lot of their customers they acquired. So I think that this happened because of this Yellow's bankruptcy. They have added a lot of customers, and they are seeing this profit jump in their recent quarter. They have actually worked on reducing their cost as well. I was reading about um, some of the comments from their CEO Raj, and some of the cost cuts that they are doing to make sure their costs are in check. So that's why they saw a good profit margin for this quarter, and their share popped up. But again, in the next quarter, I don't know if they will be able to repeat the same thing or not. But for now, they are enjoying that pop up. The investors are actually loving it. But let's see how long will it last. So that's all for today. I will see you next week, and thanks for watching Outlier Live.